I do like to start off each week with a summary of what we saw happening in the stock market. And so the first chart I have here is more of kind of a long-term chart. It's going back to the very high point. That's actually the all-time high ever for the S&P 500 was January 4th of last year. And obviously the market came down, all last year. We're starting out a lot better this year, though. And so that red line kind of is a trend line, very important in the area of what we're looking at when we look at charts. And we kept hitting it and coming down and down and down. We broke that, 3 weeks ago. So that's fantastic. First time. That's a big check mark. The blue wavy line there is the 200-day moving average. So every point on that line is the average of the 200 prior days. We finally broke through that and have held above that for more than just a couple days. We were up for before and then kind of fell back down. So that's a big one. That gold line there is actually the 50-day moving average. And you can see there where the gold line crosses through the blue line, the 50-day crosses above the 200-day. That's what's called the golden cross. That happened last week. Mm-hmm. And that's got a decent track record for reversal of trend, in this case to the upside, especially coming out of the bigger downturns. When we go back and look at, 2020, 2018, 2008, 2000, all of them, when the 50 got above the 200, that was a signal that things were finally changing. Because what we're really looking for here is we just want to see the primary direction go from down, which is where we are now, to up. And so these are all part of that checklist. And then last week, we actually checked off another box, which is where you establish a new higher high. All of those peaks are lower, and that's why that trend line is down. And so last week, we had that first time we got above that, above 4,100. Unfortunately, this week, we fell below that 4,100. That's not completely unusual. That happens. But again, we would like to see that happen, get back above that to say, hey, we really are moving in the positive direction. And then I think ultimately, probably the last checkbox that I have, I'd like to see it get above 4,300 because that's the big peak that we had back last summer. If we got above that, I think you've really kind of checked off everything I can think of to change direction, right? So really, really nice.
Yeah, you need some consolidation for every uptrend because otherwise you just get stretched too thin.
Yeah, and that's exactly what happened. I have an overall market kind of stretch model that goes from +5 when it's really low to -5 when it's really stretched out. And it got to -4, this week and last week. So there was bound to be some pullback. The problem is when you get pullbacks, you look at it and say, oh boy, is that just a small pullback because it's stretched, or are we now going back down, to some newer low? And boy, that is the huge debate right now. Mm-hmm. Read the articles. Everybody's debating this. One side thinks this is going to go. Another side thinks, oh, this is just a fake move, and we're going to go back down to a new low and go below where we were back. And that little spike down there to that 50% retracement line was October 13th. So that's the big debate. We'll have to see how this plays out. But if you look at this week, pretty wild week actually. Yep. And so just to emphasize how important the Federal Reserve is to the market right now, sometimes it's not so much, but right now, because of the high inflation and the possibility of recession, this is all about the Federal Reserve, unfortunately, because it's hard to tell what they're going to do, and sometimes I'm not sure they know exactly either. But we've got this situation. Look at this huge spike that we had on Tuesday, way up, and then way down, way back up. That was during the question and answer session for the Chairman Powell, Chairman of the Federal Reserve. He was doing a question and answer at the Washington, D.C. Economic Club, and just responding to different things that he said. Now, overall, the market was up like 1.3% that day. So the last two times Chairman Powell spoke, because he spoke the week before, when they were talking about the rate increase, market was up then too.
Yep.
And so what's happening is Chairman Powell comes out, he's kind of moderating, he's saying the things that I really am seeing myself personally in the fact, and we'll talk about some of those, but what's happening with the job market and those types of things. Unfortunately, after that, Wednesday, Thursday, we had all kinds of interviews with Federal Reserve governors, and They were much more aggressive and much more, hey, rates are going to go up not way, but they're going to go up higher than people expect for longer than they expect. And boy, there's nothing that you can really do to scare the market more than those kind of words. And I do think that was the objective. They want to see the stock market not take off. And January was hot, really hot. And if it keeps going, I mean, if you look at the NASDAQ, I think January was up, 10 to 15%. So I can't remember exactly. You do that every month, you're going to have a higher inflationary environment because people are going to feel rich. And they want you to feel not so rich. And so there is a reason why the Federal Reserve is kind of pushing on this, and we've talked about this before. And so that, of course, we've seen the market come back down and unfortunately even fall below this 4,100 level this week. And so let's kind of talk about, what's going on there and what's happening altogether. First of all, when yields go up, and so the 2-year Treasury is paying, let's say, 4.5% now.
Yep.
When it goes up, stocks go down, bonds go down, real estate go down altogether. Maybe not on a daily basis or whatever, but you can see altogether that trend was definitely strong. What went down? Real estate, stocks, and bonds. But we had I drew a little blue line in there. We had a nice downtrend going because we were getting good results from the inflation reports. And then, boom, we actually came almost all the way back up to the high point that we established last year back in October because of the report from the jobs report that came out last Friday, which we talked about some. And so we created way more jobs than expected, and people are kind of freaking out that that's going to create inflation. And I'll give you my opinion on that in a minute, but kind of the second piece of evidence of that is what the futures market kind of, I'll say, bets on where the Federal Reserve is going to end up at their peak at different periods of time. So this is July of this year, and we actually hit a new high there. We're at 5.16%. If you do the math, what that means is essentially 2 more quarter point rate increases, one in March and one in May. The May one's new, and that only started to become, a bet that would happen after the jobs report came out last week. And so now there's a higher bet that we will have 2 increases more, and then it'll pause. And so that's basically what it's saying there. And so the market's responding to that and readjusting and coming back down. The higher rates go, the more problem it is for stocks, partly because you can make 4.5% on a 2-year Treasury, for example. That's not bad. Not as good as the market has made on average, but there's not much risk in that 2-year Treasury. If you hold it for the 2 years, you got the U.S. government standing behind it, and so that becomes this competitive asset, for that. And so less money will go into stocks because more money is going into savings and CDs and Treasury bonds and those types of things, right? So that's one of the mechanisms that, and there's others, but that's one of the mechanisms that kind of drives the market down. Now, my overall thought process here is, I remember times when the Fed funds rate was at 6%, which is higher than this. We had fantastic markets. I mean, so I think it's partly an adjustment to this and how fast rates have come up. Once things do settle down, the market can still run here because even though it is competitive, it's not as good as the new AI stocks or whatever it is that people are into, at any point in time. And so really, really fascinating what's happening with the rate market.
Yeah, and you could see the market kind of followed. As the rates went down, the market went up as a whole, as a kind of an overall trend. Yeah,
and that's why, just flipping back to the 2-year Treasury, that's why I follow this so closely. It's exactly right. This is sort of a barometer for where the markets are going to go, in my opinion. So, all right, so moving on to kind of this jobs report and why I see this jobs report as positive, even though the market seems to be seeing it as negative. And I think the key differential is that, at least from the interviews from the Fed governors, from the articles that I've read, they're looking at the 1970s. And in the 1970s, we had high inflation. And in order to bring down inflation, we had to basically kill jobs. I mean, millions of jobs would have to disappear to do what they were trying to do because they're trying to kill demand, right? So, but this is a pandemic-related inflation scenario. And this is why when Chairman Powell speaks, the market goes up because he starts talking about, hey, this is a different environment. This isn't the same environment as we had in the past because this is a pandemic environment. And so what this does is show inflation, over time. Green line is overall. See the big dip in 2020, still going up. It's always been going up. It's a matter of how much. They want to have it go up at like 2%, and it's been going up at a faster rate than that. But my key point here is that if you look at the services, which is the yellow line, it's still going up. But the blue line, which is goods, really didn't have a big dip for starters, and it's starting down now.
Yeah, it's not really. It's kind of flatlining.
Yeah, because, again, what could we do during the pandemic when we were stuck in our homes? We could order stuff, but we couldn't go to the restaurant. We couldn't get on the airplane. We couldn't, they weren't even flying for a while, right? And so what are we doing now? We got this pent-up demand. It's like, well, I don't want to buy a big screen TV. I want to go to Hawaii, that kind of thing. And so the money being spent on services has been tremendous, and there's a lot of pent-up demand, and people are really getting out there and going, right? So in my opinion, if that's the high inflationary arena is services, you need more labor, because one of our problems is just that the labor force participation is still down from where it is. So, but prior to the pandemic, it was much higher. This is probably 2 to 4 million more people working than there are now. It's amazing that we don't have more, inflation, and because we have all of these job openings, and that's here too, that are kind of driving, this need for people to come back, especially in the service arena. And here they are coming back. The trend is good. Matter of fact, that job report had the highest labor force participation rate, or tied for the highest, for the year, which is good. That we need to see that. And that's what makes this different than the 70s. In the 70s, they had high participation rate. It wasn't a shortage of supply. It was too much demand, and they had a whole energy problem too with the whole thing that happened there. But nonetheless, this can be solved by getting more people back to work. So when you get, and this is from last week, but when you get 517,000 new jobs in 1 month, which is what happened in January, that's a good thing. People are coming back to work because, again, if you have a shortage of labor in your business and an oversupply of demand, look at the airlines. So if there's 3 people trying to buy that ticket for every single ticket out there, they can charge more, and they did. Boy, airline prices went up a lot. If they get more pilots, if they get more people back in, and all of a sudden there's only 1 person for every ticket, then the inflationary pressure on that starts to fall off. So we need to get people back to work, and this is part of that, right?
Yeah, and there's some speculation that February and March will also be weaker because January was so strong.
Oh, yeah. Matter of fact, they readjust these, so we'll actually find out what January's number was in, next month, because they might up or down this, and I wouldn't be surprised. It was a really surprising number. It was the biggest. It was supposed to be 188,000 jobs, right? So as far as since the pandemic, to me, that's the biggest surprise to the upside. And that's why the market is really, oh my gosh, we're going to have to raise rates way higher, and all those types of things as far as that goes. But this is an important point. The Federal Reserve governors are coming out, and they're driving and talking about higher interest rates. And the bets that are going on behind the scenes in the futures market are starting to really go towards 6%, right? Altogether. And the problem is that people are seeing this data, and they're seeing, hey, we could have lower inflation just because people are finally starting to come back to work. I think personally one of the reasons that people come back to work is twofold. Number one, there's a little less fear of the pandemic itself, the virus. Number two, they need to, because things are costing more. That inflationary pressure is kind of getting, there was lots of early retirements. Some of those people come back. There's lots of, apparently, 18 to 34-year-olds sitting at home on their couch. They might come back. Men, in this case. So who knows what they're doing. But nonetheless, I find that a very fascinating stat. I'm not sure why that is. I've been very interested in labor force participation has been dropping really since the 90s, which I find very interesting. But nonetheless, so that's what's going on here. Again, I see that as a positive for for the market, not a negative like the market seems to see, because I see this as a different situation. If you listen very closely to Chairman Powell and not so much to the other Fed governors, I think he's saying the same thing. And he seems very pleased with what's happening altogether, because he's seeing some disinflation, right? Lower inflation on goods. He's worried about inflation on services. This is one of the ways that you help inflation on services, is you get more people back into those jobs, right? So I think that's good. Now, if you can do that and also have lower wages, right? Because in the 70s, one of the things that happened, they got this wage spiral, they call it, where, the number of people coming into work, wasn't enough. And so they're raising rates and rates. So we're seeing, and this is from Friday, we're seeing the average hourly earnings rate on average year over year come down. This is a perfect situation. We had created lots of jobs, and we did so with lower wage rate increases. So I think that's very, helpful in this inflation fight, especially in the service category. So we'll see how that plays out. Okay, so there is one other thing that's happening that's very important. I'll finish up with this. Next week, on Valentine's Day, of all things, they are going to be reporting on Tuesday the CPI report. So that's the Consumer Price Index. There's two different ways that we look at this. How much inflation on that basket of goods, and I'm using core inflation here, not the overall CPI number. A lot of people know that one, but the Federal Reserve looks at core, because core does not include food and energy. The Federal Reserve considers those out of their realm.
Yeah, outside of their control.
Yeah, and probably even some of these core things are outside their control, to be honest. They don't have as much control as we'd like to think. But nonetheless, they focus on core, and when they're trying to get things down to 2%, they're talking about core inflation. So in this case, CPI was at 5.69 for the last report, right? So we're going to be getting January CPI. Well, there is a projection out there from the Cleveland Federal Reserve. They have a thing called Nowcast. So they're predicting for January 5.58, right?
Yeah.
That's not a big difference, 5.69, 5.58. But down, still continuing the trend. We'll see what actually happens. This is a projection. They actually tend to be a little bit high on average, if you look back. But nonetheless. But there is one concerning aspect, and that's the month-over-month inflation. So here's month-over-month inflation. So in this case, we're looking at this January versus December of last year. And if you look at month over month, I'd say overall that's coming down, but most recently it's actually coming up.
Yeah, slight tick up.
Yeah, and so one of the problems is if you multiply that times 12, you get pretty high inflation, right? And so 0.3, not too bad. That's 3.6%. Okay, that's awesome. But the projection is actually at 0.46%. So now you're getting back towards more of a 6% range of inflation, if I round off to 0.5 here. And so that is kind of continuing that month-over-month trend to the upside. Again, they do tend to project a little bit high here, but I also think this is one of the things that the market is looking at and thinking, okay, maybe we need to back up a little bit, get more conservative. This is what we're going to do. We've got a lot of, pieces in play, and really what I'm talking about moving are the target pieces that we have inside of our IRA type of accounts and Roth accounts and those types of things. So there's no taxes or anything. And so we'll probably rotate those target pieces. The things that are doing quite well right now in this downturn are the high dividend paying stocks, those ETFs, the utility stocks, and energy is actually making a run too. The energy can have its own path. It does all kinds of things actually. I think energy is probably running because of the reopening in China.
Yeah.
They're one of the biggest, users of energy. As they get going and their factories really get going, there could be more energy consumption there, and of course that drives things as far as that goes. So, those are areas we'll probably move those targets into and leave alone the other aspects of what we're doing. Just get a bit more defensive, still staying in the market, but in responding to what's happening here. And just let's wait and see what goes on. Again, the fear altogether is that the Federal Reserve will actually do what these Fed governors are talking about, and they'll raise rates to the point where we end up in a steep recession. I mean, one of the Fed governors was talking about, hey, it's okay. It's better to over-raise rates because we can fight inflation. Fair enough. But he says, we can always, lower them again if things get bad. Well, unfortunately, in that gap between when you stop raising rates and lower, we could have a 20% drop.
Yeah, it's a lot of hurt.
And the job losses and millions of people losing their job. I thought it was a really weird comment. I understand what they're saying, but boy, if that's your thought process, that's a little scary, and that scares the market. The Federal Reserve has overraised rates many times. They caused the 2008 downturn, in my opinion, the 2000 downturn. They did 19 rate increases before 2000 and 21 rate increases before 2008. We can look back now and say those were too many rate increases. And so the fear is that they're going to do it again. Now, Chairman Powell seems to have pretty good powers. One of the questions that came up, do you get to decide on what the rate is, or is it the Fed governors or other people that are there? It was a little bit of a confusing answer, but my overall opinion was that he has an awful lot to say on what's going to be the ultimate rate increases and where they're going to end up. He seems the happiest. He seems the most centered around all the things that I think are important to be looking at. It's why the market keeps going up when he speaks. So that's going to be an interesting battle to see how that plays out here over this first half of the year. So anyway, very, very, very interesting time to be looking at what's going on with the market and to kind of understand, boy, this environment that we've been going through here since 2020 has been very educational. If you watched, we started our videos in 2020. If you watched those and you saw what's been happening, there's a lot to learn here. It's really interesting. So anyway, that's our overall outlook on the market. A little bit longer than usual, but this is just a really incredible time right now. So